This single AI move could quietly create the next wave of millionaires, and almost nobody outside Wall Street is paying attention. A single loan for $40 billion just got wired toward OpenAI. It's not hype. It's a calculated high-risk bet by one of the most aggressive investors on the planet that artificial intelligence is about to hit a trillion-dollar moment. And if you understand what this means for AI stocks, AI jobs, and your own AI side hustles, you can actually position yourself ahead of it. Let me break it all down for you right now. So here's the headline in plain English. SoftBank, the Japanese tech conglomerate run by Masayoshi Son, has just taken out a roughly $40 billion unsecured bridge loan to pour $30 billion more into OpenAI, the company behind ChatGPT. Unsecured means there's no specific collateral pledged against that loan. It's basically Wall Street saying, we're trusting your bet on artificial intelligence so much, we don't even need you to put the house up. The deal was announced on March 27th, and it's structured as a 12-month bridge loan that matures around March 27th, 2027. The lenders are some of the biggest names in global finance: JPMorgan Chase, Goldman Sachs, Mizuho, Sumitomo Mitsui, and MUFG. In other words, 5 of the heaviest hitters on Wall Street and in Japan have just agreed to front SoftBank $40 billion for one primary purpose. It is to buy more OpenAI. This loan funds a $30 billion follow-on investment through SoftBank's Vision Fund 2, which is their giant tech investment vehicle. Once this closes, SoftBank's total capital deployed into OpenAI jumps to around $64.6 billion, giving it roughly a 13% stake in the company. That makes SoftBank the single largest outside shareholder in OpenAI, even ahead of Amazon's $50 billion commitment in the latest round. And that funding round really matters. Back in late February, OpenAI closed what is now the largest private tech funding deal in history, $110 billion raised in a single round, valuing the company at about $730 billion pre-money, and roughly $840 billion including the new cash. The breakdown there was about $50 billion from Amazon, $30 billion from Nvidia, and $30 billion from SoftBank, plus other investors layered in. So what just happened in the last few weeks is this. Step 1. OpenAI raises a record $110 billion at an almost trillion-dollar valuation. Step 2. SoftBank doubles down and borrows $40 billion more in cash to increase its position and lock in a 13% slice of whatever comes next. And credit agencies are watching. S&P Global actually shifted its outlook on SoftBank from stable to negative earlier this month, explicitly because this OpenAI bet is now such a huge chunk of SoftBank's balance sheet. I'm Kashi, this is SKM AI Expert. And now that you know what happened, let's talk about why this move is way bigger than just another funding headline. Why does this $40 billion AI update matter so much? Because of what a bridge loan really is. A bridge loan is like taking a short-term, very expensive loan while you're waiting for a big payday you're almost sure is coming. People do it with houses. Companies do it with IPOs. Here, the implied payday is an OpenAI initial public offering, a stock market listing, sometime in the next 12 to 18 months. SoftBank's loan reportedly matures in about a year. That timing is not an accident. If OpenAI goes public at or near a $1 trillion valuation, SoftBank's 13% stake would be worth around $130 billion on paper. Pay back that $40 billion. Keep a massive equity position. And Masayoshi Son gets to say, I did it again, the same way he did with his legendary early bet on Alibaba. And here's the real signal. When 5 major banks agree to lend $40 billion unsecured on a 12-month clock, they are effectively saying, we believe OpenAI's IPO is not just possible, it's likely and likely soon. TechCrunch's coverage even frames the loan itself as a de facto countdown clock to an OpenAI IPO, and that has ripple effects across the entire artificial intelligence ecosystem. First, it tells you where the smartest money thinks we are on the AI timeline, not in the cute experimental phase. In the this is now core infrastructure, we're willing to lever up to own it phase. Second, it locks in OpenAI as one of the central platforms in the future of AI. When you have Amazon, Nvidia, and SoftBank each writing checks in the tens of billions, they are not betting on a passing trend. They're betting on a long-term AI platform that powers everything from ChatGPT to enterprise co-pilots to AI automation embedded in every workflow you can think of. Third, it accelerates the infrastructure arms race. OpenAI's $110 billion round is tightly tied to compute and data center commitments. Nvidia gets guaranteed demand for its next-gen AI chips. Amazon's AWS gets locked-in usage of its Trainium hardware. SoftBank and OpenAI together are fronting the Stargate infrastructure plan, a multi-hundred billion dollar vision for massive AI data centers and power systems. At the same time, you're seeing other players scramble to build the plumbing that will carry all this machine learning traffic. Just today, Reuters reported that Enixtra, the data center arm of India's Bharti Airtel, is raising about $1 billion at a roughly $3.1 billion valuation, explicitly to build more data center capacity for cloud and AI workloads. So you've got private AI labs like OpenAI and Anthropic raising mega rounds. You've got telecoms and data center operators raising billions to build the electricity-hungry infrastructure those labs need. And then you have investors like SoftBank levering up their balance sheets to sit right in the middle of that flow. This is what a mature platform shift looks like. It's not just, here's a new chatbot. It's, here's an entire global stack of chips, power plants, data centers, and software platforms being repriced around artificial intelligence. Now, let's zoom out and talk about the business and financial impact. If you're thinking like an investor, who wins and who loses from this $40 billion SoftBank move? Let's start with the obvious winner. If OpenAI does go public around a $1 trillion valuation, and if SoftBank actually holds that roughly 13% stake, SoftBank is sitting on equity worth north of $130 billion. That's more than 3 times the size of the bridge loan. For comparison, SoftBank's own market cap in Tokyo has been hovering in that general neighborhood. So one good outcome here could, in theory, double the effective value of the whole company. That's why some analysts see SoftBank's stock as a leveraged pure-play bet on OpenAI and Frontier AI. But there's another group of winners that I'd argue is even more interesting. The picks and shovels of this AI gold rush. Think Nvidia, selling the chips that power training and inference. Think cloud giants like Microsoft and Amazon, renting out GPU clusters and AI tools as a service. Think data center developers and REITs who suddenly can justify multi-billion-dollar campuses because AI tenants are signing 10-year power-hungry leases. We're already seeing this play out. OpenAI's deal with Nvidia ties it to 3 gigawatts of dedicated inference capacity and 2 gigawatts of training power on Nvidia's Vera Rubin systems. Amazon's expanded agreement adds another 2 gigawatts of its own Trainium silicon capacity for OpenAI workloads. That is an insane amount of electricity and hardware demand. If you're looking for AI stocks with somewhat clearer business models, these infrastructure providers are where a lot of analysts are focusing. On the flip side, who could lose? One obvious risk is SoftBank itself. Credit agencies like S&P have already flagged that concentrating so much of SoftBank's assets into one highly illiquid private company increases the chances of a nasty liquidity crunch if markets turn. And remember, this loan is unsecured and short-term. If markets freeze up, if the OpenAI IPO gets delayed, or if AI valuations correct the way .com valuations did in 2000, that $40 billion bridge suddenly looks a lot more like a cliff. Another risk is for late-stage investors in private AI deals more broadly. When one funding round for OpenAI is $110 billion at an $800+ billion valuation, and its closest competitors are also raising tens of billions, a lot of the upside is being priced in very early. If you're buying shares in secondary markets at post-money valuations north of $500 billion, you are effectively betting not just on the future of AI, but on very specific execution paths in a very crowded space. Now, what about everyday people? Where are the money-making opportunities here that don't require you to be a Japanese conglomerate? I see 3 main lanes. First, indirect AI investing. That means looking at public companies that benefit from this AI explosion without being the single hyper-concentrated bet. Semiconductors, cloud infrastructure, cybersecurity firms that specialize in securing AI models and data centers, software companies that are embedding AI automation into workflows at scale. Second, AI business building. This flood of capital into OpenAI and similar platforms is essentially subsidizing the tools you can now use cheaply. ChatGPT, enterprise copilots, and the best AI tools of 2026 are getting faster, smarter, and more integrated because someone else is paying for the GPUs. That is a dream setup for anyone building an AI business, an AI side hustle, or even just an internal automation project at work. Third, we move on to skills. Anthropic's latest research suggests that, so far, AI has not meaningfully increased unemployment, but it has created a huge skills gap between power users and everyone else. The people who know how to use AI tools deeply are already getting promoted faster, paid more, and hired into the most interesting roles. So, while headlines scream about AI jobs disappearing, the immediate money is flowing to those who can actually deploy AI automation inside real organizations. We'll talk about what to do with that in a minute. But before we get into future predictions, let's make this really practical. How does this SoftBank OpenAI mega deal actually touch the life of a regular person in the US? Think of 3 buckets: work, health, and side income. First, work. Imagine you're a mid-level marketing manager at a mid-sized company in, say, Ohio. 6 months ago, you were dabbling with ChatGPT to rewrite emails. Now, because OpenAI and its backers are throwing billions at infrastructure, your company's entire Microsoft or Google stack starts shipping AI co-pilots that summarize all your sales calls, draft campaign plans, and generate segment-specific landing pages automatically. Your job doesn't disappear overnight, but the baseline expectation for a competent knowledge worker moves up. The colleague who knows how to chain together AI tools, automate reports, and orchestrate a few custom GPT-style agents suddenly looks like they're doing the work of 3 people. That's where the raise, the promotion, and the next job offer go. Second, health. A lot of this new capital is earmarked for AI systems that can do serious, high-stakes work. Think models that help radiologists spot tumors earlier, analyze pathology slides at scale, or generate first-draft clinical notes so doctors can spend more time with patients. If OpenAI and competitors can afford to train larger, more specialized medical models because they're backed by this kind of extreme compute build-out, you will start to see more hospitals offering AI-assisted diagnostics, triage, and personalized treatment planning. You won't notice the SoftBank loan. You will notice that your local clinic suddenly has an AI tool that flags anomalies in your scan that would have been missed 5 years ago. Third, side income and small business. Picture a solo Shopify seller or a freelance designer. Right now, building a complete AI automation around your business, customer support, product descriptions, ad creative, email flows, is still a bit hacky. With the coming wave of investment, the best AI tools 2026 will not just be chatbots. They'll be drag-and-drop AI agents that plug directly into your store, your CRM, your calendar, your accounting. You'll be able to spin up a full AI sales assistant or content engine in an afternoon without writing a line of code. That's massive for anyone trying to make money with AI in a practical, non-scammy way. It means more people can launch AI-powered agencies, automation consultancies, or digital products, where most of the heavy lifting is done by machine learning models humming away in some SoftBank-funded data center. Now I'm genuinely curious, do you see this kind of mega financing as a good thing, accelerating useful tools and new jobs, or as a dangerous AI bubble that's going to end badly? Drop your take in the comments. I actually do read them, and they help shape what we cover next. And if you're getting real value from breakdowns like this, you know what to do. Tap that subscribe button and turn on notifications so SKM AI Expert can keep bringing you deep dive AI updates for free. Alright, let's talk future. Where is this heading in 6 months, 1 year, and 5 years? Prediction number 1, over the next 6 months. We're going to see a wave of financial engineering spin up around OpenAI and its peers. Structured products, private funds, maybe even ETFs that brand themselves as AI infrastructure plays. SoftBank's $40 billion loan will be the reference case every time someone pitches levered AI exposure on CNBC. You'll also see regulators and rating agencies get louder about concentration risk and systemic exposure to a handful of AI names. So, expect both hype and serious risk warnings to increase at the same time. Prediction number 2, within about a year. If markets stay relatively stable, I think it's more likely than not that we see OpenAI file for an IPO or some other kind of go-public transaction. It might be a traditional listing, a direct listing, or something more exotic. But the combination of a 1-year bridge loan, a $110 billion private round, and investor appetite for AI stocks is a giant neon sign that says, "We want liquidity." An investor appetite for AI stocks is a giant neon sign that says, "We want liquidity." If that happens, you should expect the biggest retail FOMO event in tech markets since Tesla and Nvidia's big runs. Prediction number 3, looking out 5 years. AI is going to feel less like a cool app and more like a baseline utility. Just like nobody talks about the internet sector anymore, we'll stop talking about AI companies as a separate thing. Artificial intelligence will be inside every serious business workflow, every productivity suite, and every major consumer platform. The real differentiation will be who has the best data, the most efficient AI automation pipelines, and the tightest integration between human workers and machine learning systems. In that world, the biggest returns might not come from today's headline names at all. They might come from boring-sounding companies that quietly become the backbone of AI compute, cooling, power, and security. So what should you do right now to stay ahead? 3 concrete steps. Number 1, build an AI investing map for yourself. Not financial advice, but list out how you're already exposed to AI, your job, your skills, your portfolio, and where you might be over-concentrated in hype instead of infrastructure. Even just knowing whether you're betting on apps, platforms, or picks and shovels puts you ahead of most retail investors. Number 2, commit to becoming a power user of at least one major AI platform. That could be ChatGPT, Claude, Gemini, or one of the enterprise co-pilots at your job. But don't just prompt it once a week. Use it to plan projects, draft contracts, write code, analyze data. You want to be in the group that sees AI as a leverage multiplier, not a threat. Number 3, start at least one small, low-risk AI experiment that could grow into an AI side hustle or internal project. That might be automating a weekly report, building a tiny chatbot for your website, or launching a microservice using no-code AI tools. The goal isn't to quit your job tomorrow. It's to build the skills, the portfolio, and the optionality that will matter when this capital wave finishes reshaping the economy. Let's land this. A lot of people will look at SoftBank's $40 billion loan and shrug. Just more rich people moving money around. But if you zoom out, this is one of those rare moments where you can literally see the future of AI being underwritten in real time. Banks don't front $40 billion without a story they believe in. That story is simple. Artificial intelligence isn't a toy. It's becoming the next default layer of business, and OpenAI is in pole position. The question for you is not, will AI change things? It's, will I be one of the people who understands enough about artificial intelligence, AI tools, and AI investing to benefit from that shift, instead of getting blindsided by it? If you want help answering that, you're in the right place. This is Kashi from SKM AI Expert. Stay curious, stay skeptical, and stay early. Because in the AI era, the biggest edge isn't just capital, it's understanding. Hit subscribe so you don't miss the next breakdown.